So let's discuss pre-mock September 24. Question number 1. This is the part of section A. As you know, that SBR paper is divided into two parts, section A and section B. In section A, there are two questions, and in section B, also there are two questions. In section A, it is question number 1 and question number 2. Question number 1 is from group accounting for 30 marks, and question number 2 will be from a financial reporting issue followed by an ethical issue of 20 marks. Okay, so we'll discuss section A now. Is the screen properly visible to all of you? Can you please confirm? Is the screen properly visible to all of you? Wonderful, wonderful. Now, so let's read the question and try to solve it in a proper manner. I will increase the size as well, okay, so that you can read the things properly. So the question says, Halliwell Company operates in a film industry, okay? It prepares financial statements in accordance with IFRS accounting standards. The financial year ends on 31st December 2007. The point to be noted, never forget this line. As I've already told that this is the word, this is a sentence, this introductory paragraph. This is called as an introductory paragraph. So you always need to read this introductory paragraph to get the basic understanding of what exactly is the industry in which this company operates, or what exactly is the financial year end of this company. So to get this basic data, you need to read the introductory paragraph. Okay, now the financial year end is 31st December 2007. Now the question further says the following exhibits available on the left hand side of the screen provide information relevant to the question. So what are the exhibits provided? There are 4 exhibits given. Okay, acquisition of a Carter company might be during the year we have acquired some company. Okay, it might be a subsidiary, it might be a joint venture, it might be an associate. Okay, depending upon the situation. Now investment in Bhalla company. Again, it can be an associate, it can be a subsidiary, it can be anything. Now, financial asset and extract from draft P&L and OCI. Now, as we know that in question number 1 of group accounts, we get a pre-populated screen for in which we need to adjust the exhibits given to come at the final group financial statements. It can be a group P&L, it can be group SOFP, or it can be group cash flow. It can be anything. It can be anything, right? In our classes, I believe we have discussed how to present group SOFP, how to present group P&L, and how to present group cash flow. Everything we have discussed, I guess so. Okay. Now, so what we'll do is now, first of all, we'll go to the requirements. Rather than going to the exhibits, we'll go to the requirements. We'll copy the entire set of requirements. We'll copy the entire set of requirements, copy, and we'll paste in word processor. And we'll paste in word processor, right? Then we'll format it a little bit. To some extent, we'll format it, right? And done. Bang on. We are here. So now we will start to solve each one of them now. Okay. So now there is no need to open the requirements window. Just close it off. Tata bye bye. And let us work towards this one. This is the file where we need to write the answer. This is the file where we have the question as well. Okay. So both of them are in one place. Now, what is the requirement number 1 stating? Never go to exhibits directly. Okay. Read the introductory paragraph, come to the requirements, copy the requirements, paste in word processor. Now, in the word processor, read the requirements, and according to the requirements, go to exhibits. Okay. According to requirements, go to exhibits. Students make a mistake that they first go to exhibits, read all the exhibits, and then come to requirements. No, no. First of all, you read the requirement, and according to the requirement of the question, you move between the exhibits. Okay. Now, part number 1. Using exhibit 1. Using exhibit 1. Explain with calculations. So in this question, we need to explain, we need to write the theory, Gyan, plus we need to show the calculations. Okay, that is how to correct the treatment of investment in Carter in the console financial statements for the year ended 31st December 2007. Your answer should include a calculation of goodwill or gain on bargain purchase arising on acquisition. Batao question ko now tell me without even reading the question, this investment in Carter is an investment in subsidiary, associate, or a joint venture? Don't read the exhibit. Don't read the exhibit. Without reading the exhibit, can you tell me this investment in Carter is a subsidiary, associate, or a joint venture? It's a subsidiary. Why? Because the question is talking about goodwill or gain on bargain purchase, which arises only in the case of subsidiary. Right? So now let us start reading the question one and then try to answer it off as well. On 1st March 2007, this is Exhibit 1, acquisition of Carter. On 1st March 2007, Halliwell acquired 80% of the $8.9 million one ordinary equity shares of Carter. Prior to its acquisition by Halliwell, Carter has produced several unsuccessful films. Okay. Halliwell agreed to make an immediate $24 million cash payment of the equity shares as well as a further $6 million. Now, immediate $6 million cash payment. This is what? What does this mean? Can you tell me? What does this mean? Immediate $6 million cash payment. It's a cash consideration. It's a cash consideration, right? It's a cash consideration. Now, okay, cash payment for the equity shares as well as further $6 million cash payment in 3 years time. 3 years time might be, it can be deferred consideration. But see, there is a condition attached to it. If Carter achieves a required level of box office revenue during that time, it is a contingent consideration. Why? Because there is a condition attached to it. There's an uncertainty attached to it. Now, at 1st March 2007, that is the date of acquisition, the fair value of this contingent consideration happens to be $3.56 million. So this is the fair value which we'll consider in our investment. That is purchase consideration. By 31st December 2007, Halliwell's performance has improved, and that the fair value of this contingent consideration was measured at 4.5 million. Tell me now, while calculating goodwill, will we consider 3.56 or will we consider 4.5? Come on, guys, tell me. 3.56. Now, at reporting date, that is 31st December 2007, in our console SOFP, will we report 3.56 or 4.5 in console SOFP? At reporting date, will report 4.5. Then where will this difference of 4.5 and 3.56 go? Where will this difference go? Tell me. This difference will go to P and L. Okay. Now, then let's talk about the retained earnings. So now what we'll do is, first of all, we'll write about this contingent consideration. So let me write about this contingent consideration. Contingent consideration is a topic for the day. Contingent consideration. Now tell me, do you want me to write the answer as you have to write in exam, or do you want me to just write the bullet points? Tell me, what exactly do you want? If you write the bullet points, it will be done fastly. Okay, so I'm writing in bullet points. You can frame the sentences from that. Okay, I'm writing in bullet points. You can frame the sentences from that. Now, contingent consideration. So you have to write contingent consideration is measured at fair value on date of acquisition. Any subsequent fair value changes is recognized in P&L. Okay, now then at date of acquisition, fair value of contingent consideration is 3.56. Okay, which will be considered while calculating goodwill. Then subsequently contingent consideration is increased. Fair value of contingent consideration is increased to $4.5 million. 4.5 million. Okay, which will be reported in console SOFP at reporting date, that is 31 December X7. Now, change in fair value by 4.5 minus 3.56 is equals to how much it is? 4.5 minus 3.56 is equals to 0.94. 0.94 million is recognized in P&L. Done. Bolo, clear? Is that clear, everyone? Is that clear, everyone? Okay. So this is a, you can write here, fair value loss. Okay. Because your liability has increased, right? Your liability has increased. Contingent consideration is a liability. Your liability has increased. It's a loss for you, right? It's a loss for you. It's an expense. Come on, guys, tell me, is it clear, everyone? Now, moving on to the next paragraph. So we have fairly dealt with the paragraph number 1. This is the first paragraph. We have fairly dealt with it. Now, moving on to paragraph number 2, that is this one. It says on 1st March 2007, Carter's retained earning and other components of equity totaled at 26.6 million. On this date, the fair value of 20% shareholding in Carter was 7.12 million. So that gives you a fair understanding of NCI, non-controlling interest. So it's right, you write here, it is the Halliwell's policy to measure NCI at fair value on date of acquisition. It's right here, right? NCI is measured at fair value on date of acquisition. That is, which is measured at $7.12 million. Okay, done. Now NCI also done. Sorted. NCI also sorted. Now tell me, what else do you need? NCI done. Fair value of net assets. Fair value of net assets. Okay. Now in fair value, what is the carrying amount of net assets? Can you tell me what is the carrying amount of net assets? So carrying amount of net assets is equals to equity share capital of how much? Equity share capital of how much? 8.9 million, right? Because Halliwell company acquired 80% of 8.9. So total equity capital of Carter is 8.9 million. Equity capital is 8.9 million. And other components of equity is how much? Other component of equity is how much? So that totals to retained earning and other components of equity total to 26.6 million. Totals to 26.6 million, which gives you a carrying amount of net assets as 26.6 plus 8.9. That is 35.5. 35.5. Right now, further, we also need to account for the fair value adjustments. Now, what is the meaning of fair value adjustments? So fair value adjustments basically means that what is the difference between the carrying amount of net assets and the fair value of net assets, and we need to account this difference as fair value adjustments. Also, there might be a case that there are assets and liabilities which are not recognized in the financial statements of subsidiary company, that is Carter company, but upon consolidation, or when the Halliwell company acquires Carter company, upon acquisition, these assets or liabilities might needs to be accounted for. For example, brand name, for example, customer lists, for example, contingent liabilities. All of these needs to be accounted at fair value on date of acquisition. Further, there is also something called as research cost. If subsidiary company has incurred a research cost, right now prior to date of acquisition, so even that needs to be recognized by the group at its fair value on date of acquisition. Generally, I've seen students tend to make this mistake in the exam, that they ignore these things. Okay, so keep in mind that whether the assets are recognized in the books of subsidiary or not doesn't matter. If they have a fair value on date of acquisition, they needs to be recognized in the group FS. Now, so further it says Carter Company produced and owns the rights to one of the first ever made films. However, Carter has not recognized this as an asset in the individual financial statements. Halliwell attributed a provisional fair value of 1.4 million to these rights on 1st March 2007. What is the meaning of provisional fair value? So there is a concept called as measurement period. Do you know this thing? Tell me. There is a concept called as measurement period. So under the measurement period, what we do is we take a bandwidth of up to maximum 1 year, within this period we just see what is the fair value on date of acquisition. We try to calculate fair value on date of acquisition. So now in this measurement period, there might be some new information available to us, which becomes available to us. If this information existed on date of acquisition, we will account for this new information and adjust my goodwill and all other calculations accordingly. But if this information which becomes available to us within 1 year from date of acquisition, okay, this information is a new information, that is it arose after date of acquisition, okay, it didn't exist on date of acquisition. See, understand, when I'm saying new information available, it means if the information was existing on date of acquisition, but we were not aware of it, okay, we became aware of it right now, okay, in that case it will be we have to adjust it on the date of acquisition and accordingly calculate goodwill or everything else. But if the information that becomes available to us now didn't exist on date of acquisition, then it needs to be accounted for as per respective standard. Now, so it's a provisional fair value of 1.4 million to these rights on 1st March. After completing a full fair value exercise on 31st December 2007, it was determined that the rights had a fair value of 1.6 million on 31st March 2007. Okay, sorry, 1st March 2007. So what will be the fair value adjustment? So fair value adjustment that we have to do is point number 1. We can write here. It is for what is the name of that? Rights to film. Rights to film. That is by 1.6 million. 1.6 million. Then further, during February 2007, one of the Carter's camera operators brought a legal case against it because of an injury suffered during filming. Carter has disclosed a contingent liability in its individual financial statements, and the fair value of the damages is 0.43 million. So you have to write fair value of contingent liability. Will be recognized at 0.43 million, 0.43 million, 0.43 million. Okay. Now, considering all this, what else? Carter income, expense, and other comprehensive income from its individual finances have been included on line by line within the draft console P&L. So now the question is saying that Carter's, that is subsidiaries, income, expense, other comprehensive income from its individual financial statements has been included on a line-by-line basis in the draft console P&L. The resultant profit and other comprehensive income has been allocated to the owners and Halliwell company. So basically, the process that they have taken for group accounting, group P&L is correct. The process that they have taken is correct, but in this process, they have made certain mistakes which we need to rectify, and these are the mistakes which we need to rectify. However, no other entries or adjustments relating to Carter have been made. So they have just done the line by line addition, nothing else they have done. Okay, line by line and allocation, that's all, nothing else. So these adjustments are to be accounted for. They are not yet accounted, they have to be accounted for. Okay, so we need to account for these adjustments. So now, first of all, what we have to do is we have to calculate goodwill. So let's open up the spreadsheet and calculate goodwill. Working note number 1, not working note, part A, calculation of goodwill or gain on bargain purchase. Now, so for that, we need what is the value of investments? What is the value of NCI fair value at date of acquisition? Now, less. What is the fair value of net assets at date of acquisition? So these are the 3 things which we need. Now, in investments, we can write here cash consideration, and we can write here fair value of contingent consideration. So now what is the cash consideration? 20. So we have to write all the amounts in thousands. So I will write here amount in dollars, comma, thousands. Okay. Now, simple. So it is 24 million, meaning thereby 24,000. Fair value of cash consideration, we estimated at 3.56 million, right? So 3,560. Okay, now So this gives you a total investment figure of how much? Sum. Done. Now, what is the NCI? 7.12 million, 7120. Now, what is the fair value of net assets? So for that, you have to write here share capital, then you have to write just equity capital other components of equity. Then you have to write further two further things were there, right? What were they? Rights to film and contingent liability. 1.6 and 0.43. ठीक है. Rights to film is okay, and fair value of contingent liability. So now what is the equity capital? It is 8,900. Now what is other components of equity? That is 22,600. What is rights to film? It is 1,600. And what is the this one? It minus 430,000. I believe it is very much clear to all of you. Right? So what is the fair value of net assets? So again, sum this much. So this will be a negative figure here, ideally. This would be a negative figure here. So this much. Now, what is the value of goodwill? So sum again. Two zero one zero. Is it correct, everyone? Come on, guys, please confirm. Uh, can I just have the data, please? 26.6 it is, not 22.6. Sorry, my bad. 26.6. It is 26.6. That is 1990. Oh my God, negative goodwill. Negative goodwill. So negative goodwill means what? Gain on bargain. Gain on bargain purchase. Gain on bargain purchase. Now, so what will you write here? Coming back to your solution. Now you have to write here further goodwill. Okay, you have to write here on calculation of goodwill, we get negative goodwill, which is called as gain on bargain purchase. Now tell me, what is the treatment of this gain on bargain purchase? Can you tell me what is the treatment of gain on bargain purchase? What is the treatment of gain on bargain purchase? Come on, guys, tell me. It is to be recognized in P and L as income. Right? Sorted? Very much sorted. So this is what we have to do for 11 marks. So we have to explain contingent consideration. You have to explain what is the NCI. You have to explain fair value of net assets. Definitely, you have to give a little bit of explanation for the fair value of net assets. That why do we recognize? Why are we recognizing fair value of films? Why do we are we recognizing fair value of contingent liability? Just one sentence is more than sufficient. Then you have to write this line of our goodwill, and you have to show this calculation. I believe it is fairly clear to all of you. The question number 1, part A. Question number 1 part is very fairly clear to all of you. Come on, guys, tell me. Right? Well, now moving on to question number A. Okay. Now what we can do is rather than moving on to question number B, let us first of all adjust the spreadsheet for part A. So now what are the adjustments that you have to make? Okay, what they are doing is they are already giving you the console P&L, group P&L, but they are not giving you the group P&L entirely. They are just giving you the extract of group P&L. They are starting from profit for the year. They are showing other comprehensive income. They are showing the allocation of profits to owners, and NCI is what they are showing. Now we have to make the adjustments here. So now tell me, what are the adjustments that we have to make? What are the adjustments that we have to make? Tell me. The first adjustment that we have to make is a fair value loss on contingent consideration. The second adjustment which we have to make is, tell me what? Come on, guys, tell me. Come here and tell me. Now, first is contingent consideration fair value loss, because it's P&L. It's P&L, right? So we have to do that. NCI, there is no specific adjustment that we have to do. Fair value of net asset, there is no specific adjustment that we have to do. Now, gain on bargain purchase. Now, next is gain on bargain purchase. Gain on bargain purchase. Now tell me, what will happen? Fair value loss was amounting to how much? Fair value loss is how much? Fair value loss is how much? 0.94 million, meaning thereby 940 amount. 940 is amount, right? So it will decrease the profit by 940, yes or no? It will decrease the profit by 940, right? Now, because it's a loss. So now, will it have any impact on the other comprehensive income? No. It will reduce the profitability of the parent by 940. Now, will it have any impact on the NCI? Come on, guys, tell me, will it have any impact on the NCI? No, because the parent is recording this contingent consideration. If subsidiary would have recorded something and there was a change in the subsidiary's profit or loss, definitely it will impact the NCI. But since it is impacting the profit or loss of the parent company, it will have no impact on NCI. Similarly, we have to adjust this one also, total comprehensive income as well. So this is the impact of this one. Now for the gain on bargain purchase is to be treated as an income. So we have to increase the profitability. Again, who is recording this gain on bargain purchase? The parent company. Parent company, right? So will it have any impact on the NCI? No, my dear friend. No, no, no. So it will increase here plus 1990. Now plus 1990. Is it sorted, everyone? Clear? Adjustment number 1A, this is the only treatment which we have to do. Okay. Now, so let's close the spreadsheet now. No need further. Moving on to part B. Moving on to part B. Using exhibit 2, again, explain with calculations how to correct the treatment of investment in Valla in console statements for the year in 31st December 20x7. So let us open the investment in Valla. Bhalla or Bhalia? Here it is in Bhalla, here it is in Bhalia. It is Bhalla. They have written here wrong. Now, Halliwell company, Halliwell Group has a presentation currency of dollar. Okay, fine. Now, on 1st October 2007, Halliwell bought 35% of equity shares in the film studio. 35% means what? It might be an associate or a joint venture. Bhalla has a functional currency of Rimini. Rim. Oh my God, this is a case of overseas investment. The investment cost RM 136.4 million and gave Halliwell joint control over Bhalla. Halliwell determined that Bhalla was a joint venture. Okay, the treatment of associate and joint venture is the same. Bhalla reported profits of RM 48 million in the year ending 31st December 2007. Relevant exchange rates are this much. In the draft console SOFP, the accountant has recognized the investment Bhalla at cost and translated this using the exchange rate on 1st October 2007. No other accounting entries has been rating to Bhalla has been made in the draft console financial statements. So let us deal with that. First of all, let us do the calculations. First of all, let us deal with the calculations. Okay. Now coming to spreadsheet and part number 1B. Part 1B. So let us deal with the calculations first of all. Now, how to account for it? Tell me how to account for the investments. So this is investment in Bhalla is a joint venture. Now, tell me how do we account for joint venture? Tell me how do we account for joint ventures? Come on, guys, tell me how do we account for joint ventures? So right here, investment in Bhalla is a joint venture which has to be accounted as per equity method. Equity method, that is in group P&L. If the question is asking about group P&L, so we have to just recognize share of profit, share of profit as a single line, item. Right now, if I talk about group SOFP, so then we have to recognize just investment in Bhalla at equity method, method, single line item. Is that clear, everyone? Is that clear? Now let us understand that. Now what we have to do is, let us come to a spreadsheet. Now tell me, what is the investment in Bhalla? What is the investment in Bhalla? So first of all, what we have to do is we have to do all the calculations in Rimini. Then we have to take the exchange rate and then we have to convert it to dollars. Right? That's what we have studied. That's what we have studied for investment in overseas. Right now, so investment in Bhalla on the date of purchase. On date of purchase. Now further, what we'll do is we'll add share of profit. We'll add share of profit. That is post acquisition share of profits. We'll add. Right now, this will give you the closing investment. Okay. Now again we have to find the closing investment. Fine. Okay. Chalo, how to do this? Let us find out. So opening is how much? Tell me first of all. Opening is how much? Opening is 136.4 RM. Opening is 136.4 RM. Now, what is the share of profit? How much profit? So Bhalla has earned a profit of 48 million for the year in 31st December, and one we have acquired on 1st October. So what is the post acquisition? October, November, December, right? So in the share of profit, can I write it like this? Is equals to 48 million multiplied by 3 by 12 multiplied by 35%. Tell me, guys. Is it logical to say it like this? Is it logical to say it like this? Because we are calculating all the figures, first of all, in Rimini, foreign currency, and it is then we will calculate everything in dollars. First in Rimini and then in dollars. That's how we have discussed foreign operations, right? Now, what is the closing investment in Rimini? So this plus this is the closing investment. Any impairment? No, my dear friends, no impairment. So rather writing like this, we have to write like this. So this plus this. Okay. Now tell me, what is the exchange rate? What is the exchange rate that we will use? Come on, guys, tell me, what is the exchange rate for date of purchase? We will use 1st October exchange rate, that is 22. Now, how to decide whether to divide or to multiply? So it says $1 is equals to 22 RM. So to convert to dollar, we have to reduce the amount, right? We have to reduce the amount. So we have to divide. So we have to divide. So by 22 here. Now, this share of profit is the during the year element. So it is average rate will take. So divide by 20. Divide by 20. And closing investment is the closing amount. So it is 1019. So divide by 19. So this is what we have to consider here. Okay. Now, what is the amount? So 136.4 divided by 22. 4.2 divided by 20 and 20. And here it is closing investment is 140.6 divided by 19 is 7.40. So this is it. Now tell me, According to this and this, what should be the closing investment? This plus this. But what is my closing investment actually standing at? Where is my closing investment actually standing at? 7.4. So what is the difference? So this minus this is the difference. 0.99 is the difference. This is called as exchange gain or loss. Tell me. This is called as exchange gain or loss. Tell me. What is it called as? Exchange gain. Very good. Now, where is this exchange gain recognized? Where is this exchange gain recognized? So it is recognized in other comprehensive income, and from there it will go to foreign currency translation reserve. From there it will go to foreign currency translation reserve. So I write it like this. Firstly, first in OCI, then transferred to FCTR, foreign currency translation reserve. So this is the treatment. Now tell me what is the adjustment that we have to do for this one in the pre-populated screen? What is the adjustment that we have to do for this one? So first of all, we have to recognize share of profit. We have to recognize share of profit. How much it is? 4.2 million divided by 20 is 0.21 million into 1000 is 210, right? So what we'll do, we will add, yeah, right here, share of profit of joint venture. So it will be, we have to increase it by 210. We have to increase it by 210. Now, this joint venture is an investment done by the parent company. So will it impact the NCI? Will it impact the NCI? No way, no way. So it is 210 here and it is 210 here. I believe it is very much clear to all of you. Now comes exchange gain. Exchange gain. So exchange gain on joint venture. So will it impact the profitability? Will it impact the profitability? No. We will. Why full amount added? Okay, now tell me then why not? Why not full amount? Tell me, Sita, why do you think full amount will not be added? Come on, tell me. Why do you think so that full amount will not be added? Because this full amount is already proportionate for the time and the percentage. This amount is already proportionate for the time and the percentage. Now it is in 0.21 million and now we are writing in thousands. We are preparing it in thousands. Okay. 210 is the share of profit. 210 is now exchange gain is how much? Exchange gain is how much? 0.99 million. 0.99 million. So it is 990 exchange gain. So we'll write here exchange gain here. Exchange difference on transaction 990 will come here. And will it come here? No, it will come here 990. Okay. Now, so this is the treatment for this one. So any other adjustment that has to be done? No. So you have to write here share of profit. How did you calculate that? You have to write exchange gain. What is the treatment? So you have to write here for the pointers for say treatment of share of profit. You have to write the treatments for exchange. You have to write that it is an overseas investment, and hence you have to calculate exchange gain or loss. Now, while calculating exchange gain or loss, you have to say that opening investment at opening rate, closing investment at closing rate, profit at average rate. The difference is called as exchange gain or loss. Now, this exchange gain or loss is for the parent only, not for NCI, and hence the entire amount of exchange gain or exchange loss, the entire amount of exchange gain or loss is to be recognized in other comprehensive income, and from there it will be transferred to FCTR. Had this exchange gain or loss in case of subsidiary, then what we would have done? Tell me. If this exchange gain or loss would have arisen on acquisition of a subsidiary, then in that case, the parent share will be recognized in other comprehensive income and transferred to FCTR. But the NCI share will first be recognized in other comprehensive income, but from there it will be transferred to NCI. From there it will be transferred to NCI, okay, not to FCTR. Now, further, so this is the treatment of exchange 1B. 1B, I believe it is clear to everyone. 1B, I believe it is clear to everyone. I've shown all the calculations. I'm just leaving the explanations part to you guys so that you can just write the explanation, and how to write the explanation that also I've explained here. Okay, I believe that that part you can do. I believe that part you can do on your own. Wonderful, wonderful. Now moving further. So what is the requirement? Coming to what processor requirement? So this part B is done. Now coming to part 3, part C. Using exhibits 1, 2, and 3, as well as the previous answers, adjust the pre-populated spreadsheet to correct the extract from the draft console P&L and other comprehensive income for the year in 31st December 2007. So meaning, Devasi, we have already adjusted exhibit 1 and 2, we have already adjusted, right? Exhibit 1 and 2 we have already adjusted. Now it is asking you to adjust exhibit 3 as well. But is the question asking anywhere to give any write up about exhibit 3? Now tell me, in this requirement, it says using exhibit 1, 2, and 3, you are required, as well as your previous answers, adjust using the exhibits, adjust the pre-populated spreadsheet. Now tell me, whatever is the adjustment that is required in exhibit 3, are you required to give a write-up or explain anything for that? No, you are not. You are just required to make the adjustments in the pre-populated spreadsheet. That's all, nothing else. That's all, nothing else. Is that clear to everyone? Is that clear to everyone? Come on, guys, tell me. So now the need of this one is over. Close it now. So we need pre-populated spreadsheet and we need financial asset exhibit 3. We need exhibit 3. Okay, now what is it talking about? Let's read the exhibit and see what exactly has to be done. On 1st January 2006, Halliwell invested $10 million in 5% loan notes, a financial asset that are redeemable at a premium in the future. The effective interest rate is 8%. The loan notes were classified as measured at fair value through other comprehensive income, and they were correctly reported in console SOFP at their fair value of 10.42 million. So what it says that I have invested in 5% loan notes, a financial asset that are redeemable at premium in the future. Now, since it is redeemable at a premium, the premium is called as transaction costs, and it gives rise to what effective interest rate. So now what is the difference between 5% and the effective interest rate? Meaning thereby we will use the effective interest rate to record the finance income, but we will use this 5% to record the contractual receipts. Right? Is that clear, everyone? Is that clear, everyone? So to record finance income, we will use 8%. To record contractual receipts, we'll use 5%. Now, the loan notes were classified as measured at fair value through other comprehensive income. Wonderful question. A wonderful question. Isita, if you remember, we discussed this question in depth over a call last day. And see, this question is here. Right? Now, the accountant has made no entries in the year ending 31st December 2007 other than to recognize the interest received. Interest received, that is 5% as finance income. Blunder mistake done. Blunder mistake done. So what ideally has to be done, I will show it to you. What ideally has to be done, I will show that to you. So let's write here exhibit 3. Financial asset. How to recognize the financial assets at FVT OCI? At FVT OCI. So right here, opening financial asset, finance income at 8%. Okay, then receipts at 5%. Then closing FA. Then what is the fair value? And then what is the fair value gain or loss, which will be recognized in other comprehensive income? Okay. Now, so now tell me, what is the opening FA? At what price did we purchase? 10 million. We purchased at 10 million. So I'm writing the figure in millions only now. 10 million. So what is the finance income? The finance income will be this multiplied by 0.08. Now what is the Now what is the receipts? So this multiplied by 0.05, right? Now what is the closing FA? So it is this plus finance income minus closing receivables is 10.3. What is the fair value? It is 10.42. Now what is the fair value gain or loss? It is this minus this, that is 0.12, which will be recognized in other comprehensive income. Now what is the opening next year? So the opening next year is 10.42. But now comes the question, tell me, when we are recording the finance income, will we record at 8% of 10.42? Will we record at 10% or 8% of 10.42? No, my dear friend, no. So we will record at 10.3 ka 0.08, 10.3 ka 0.08 without fair value. Finance income has to be recognized as per the finance income schedule, ignoring the fair value, ignoring the fair value, ignoring the fair value. So it will be this much. It will be this much. Now, finance receivables will be how much? Receivables will be again 0.05 only. It will be 0.05 only. Now, so what is the closing FA? The closing FA will be equals to this plus this minus this. And the fair value is how much? 10.65. So what is the fair value gain or loss? So again, copy, paste, 0.09. 0.09 is the loss. 0.09 is the loss. Come on, guys, tell me, is that clear, everyone? Is that clear, everyone? Now, what is the mistake done in the while preparing P&L? So finance income, wrong finance income that is recognized is they have recognized a finance income of how much? 10 into 0.05, 500, right? So we have to remove minus negative 500 minus 500 minus, so it will reduce the profitability, it will reduce hence it from here also, we will reduce it from here as well, and we'll reduce it from here as well. Not here, not here, and from here as well, minus 500. Now we will account for the correct finance income. Correct finance income. So correct finance income for the year in 31st December 20x7, right? So our financial income is, tell me, what is the financial year ended 31 December 20x6, because it was purchased on 20x6. Now this is financial year ended 31st December 20x7. Now our reporting date is 20x7. So what is the finance income which we will record? 0.82. So what is the amount? So rather I'll say 10.42 into 1000 into 0.08 is 8. 10.42 into 0.08 is 8336. No, sorry, 10.3 into 0.08 is 824, is 824. So this, if you just include further system number, okay, so basically what you have to do is finance income which you have to record, finance income, correct finance income which you have to record. I can take 0.82, but there is challenge in that. I'll tell you what. So it is 10,300 multiplied by 8%. That comes to actual will comes to 10,300 into 0.08 is 824. So it's 0.82, no? So the 4 is hidden here. The 4 is hidden because we are taking two decimals only. Okay. So it doesn't give us the correct picture. So which will make my P&L wrong. So I want to take the accurate figures. So it's 824 in thousands. So I'll take the correct finance income as 824. So this is what we will recognize here. Correct finance income will be 824. So it will increase by 824 by plus 824 and increase my profitability by 824. Increase other comprehensive income by 824. Okay, so now this is correct, done. Further, we also need to recognize the fair value gain or loss, that is 0.9. Fair value gain or loss. Let's calculate correct fair value gain or loss, or the fair value gain or loss. So fair value gain or loss is how much? What is the carrying amount of financial asset on 31 December 20x7? That comes to, is equals to right here 10,420 plus 824 minus 500 is the correct amount. 10744 is the correct amount. Now, what is the fair value of financial asset on 31 December 20x7? Okay, that comes to 10650. 10650. So, what is the correct amount of it? So, the fair value loss is coming to 94. Fair value loss is 94. So this will be recognized in where? Other comprehensive income. This will be recognized in other comprehensive income. So let's write here other comprehensive income. Other comprehensive income. So there is no figure here. So let's write here financial asset fair value loss on financial asset at FVTOCI. Okay, so how much is the amount? So let's write here it is 94 is a loss. So minus 94 minus 94. Now it is a fair value loss, okay, of financial asset at OCI. So this will reduce my other comprehensive income. Now, so will it have any impact on the profitability? No, it will have an impact on the other comprehensive income. Again, it will reduce the profitability of the owners only, not for the NCI. So this is the treatment, overall treatment. Now, can you find out the final group P&L? Find out the group P&L final. So it is very much easy now. It is very much easy now. Is equals to sum, is equals to sum. Tick, 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 tick. Done. So this is the correct amount of group P&L. So copy. Now what is the correct amount of exchange difference? Is this much. Correct amount is this much. Now let us copy this, and paste. 2320. Why 2320? Why? No formula here. Array. Formula here, formula here. Okay. ठीक है. So let us put the formula. Insert the formula is equals to sum. Sorted. 3216 sorted. Okay. Now further coming up to here. Coming to here. Copy for formula. Paste the formula. Paste the formula. 6980. Done. Okay. Then paste this formula. Copy. Paste this formula. 47234. So this 40254, 40254 plus 6980 is 47234. Right? Now done, sorted. Now come here as well. Similarly here also it will be same thing. Copy, paste. Done, sorted. Okay, done. Okay, done. That's all you are required to do. Now you can insert a comma if you want here. You can insert a comma if you want here. Done. So this is the correct group P&L. This is the correct group P&L. Is that clear, everyone? Was that question difficult? I don't think so. I don't think so. It was a difficult question. Now tell me what according to you is the opinion? Are you clear on this part? Tell me, guys, is it clear, everyone, till here? Wonderful. So let us close this part now. Close. Moving on to question number 2. Now let us move on to question number 2. So question number 2, as you know, that it is deals with a financial reporting issue plus an ethical issue. So let us read the question and understand what's the requirement and then solve accordingly. So question says Gilliam company constructs a commercial property which it either sells or holds out to lease out to tenants. So it either sells the commercial properties or gives it on rentals. Okay. Financial statements are prepared in accordance with IFRS accounting standards. It has a financial year end of 31st December 20x7. So please highlight that this is a financial year end. So we always need to keep this in mind. Now, the following exhibits available on the left hand side of the screen provide information relevant to the question. So now these are the two exhibits, sale and leaseback and the internal email. You are required to read the exhibits and solve the requirements. So what we'll do, will we go to the exhibits now? No. First of all, we'll go to the requirements. Copy the requirements as it is. Copy, close, open the word processor, copy the requirements as it is. Let us format it to some extent. Okay, and done. So now move, what we'll do is we'll try to answer exhibit 1 first. So requirement 1 first. So what is requirement A saying? Using exhibit 1, explain with supporting calculations. So you have to explain with supporting calculations how the sale and leaseback arrangement should be accounted for in Gilliam's company financial statements for the year end 31st December 2007. Okay, so this is sale and leaseback arrangement. That's a quite easy. That's a quite easy. That's a quite easy, right? That's a quite easy thing. Now, what will we do? What will we do? Tell me. What will we do? Coming to sale and leaseback exhibit 1. Exhibit 1. So what is Exhibit 1 saying? One of the Gilliam's investment property is a west side, which it leases to tenants. Gilliam built this property 2 years ago following the sustainable building guidelines. Oh my God, there's a concept of sustainable building guidelines recommended by the government. For subsequently, Gilliam has not followed these guidelines. Okay, not follow these guidelines. So definitely we might need to comment on the sustainability as well, but definitely not as part of part 1, because part 1 we have to answer from a sale and leaseback point of view. Now it says Gilliam applies the fair value model to investment property. Okay, fair value model is applied in its interim financial statement that is ending on 30th June 2007. The carrying amount of Westside Tower was equivalent to its fair value. So it says point number 1, carrying amount is equals to fair value. Carrying amount is equals to fair value. Carrying amount is equals to fair value is equals to 20 million. Is equals to 20 million. Now, what is the sale proceeds? Fair value is okay. It says that fair value remains unchanged at 31st December 2007. And you know that when the investment property is at fair value model, we do not depreciate the investment property. We do not depreciate the fair investment property. So meaning thereby carrying amount on 31 December 2007 will be this one only. Okay, now equals to fair value. Now on 31st December 2007, Gilliam intend to sale and leaseback arrangement in relation to the west side in order to realize the cash. So we have discussed in our regular classes that when a company enters into a sale and leaseback, the intent behind that is to arrange funds. Now, so sale and leaseback accounting will happen only when the sale is classifies to be a sale as per IFRS 15. Now it says the transfer of west side met the criteria in IFRS 15 revenue from contract with customers to be a sale. So it is genuine sale. Okay. So now it will be, we have to give the accounting of sale and leaseback because it's a genuine sale. We have to give the accounting of sale and leaseback. Now, if this would have been a scenario, there will be a scenario that this is not a genuine sale, then what we would have done in that case, we will say that since this is not a sale, there cannot be a lease. Now, since this is not a sale and lease back, this is a financing arrangement. This is a financing arrangement. Now, under the terms of sale and leaseback arrangement, Westside was sold for $22 million and immediately leased back for a term of 10 years. Immediately leased back for a term of 10 years. Payments are made in advance and commenced on 31st December 2007. So now sold for what price? So right here, it's sold for $22 million. So now what is the journal entry for sale? What is the journal entry for sale? Can you tell me? What is journal entry for sale? So journal entry for sale will be bank account debit to Westside property. In bank, it will be 22 million. In bank, it will be 22 million. And in Westside property will be 20 million. But now understand, why will someone purchase at a price above its fair value? Tell me, will you purchase any asset above its fair value, above its market price? No. Meaning thereby the additional 2 million which the counterparty has paid is a loan arrangement, is not a gain on sale, is not a gain on sale, is not a gain. So it is a financial liability. It is a financial liability to the extent of 2 million, to the extent of 2 million. Meaning thereby there is no gain or loss on sale. 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 Now, if this would have been a scenario like this Westside property was sold, let's suppose the carrying amount of this Westside property. Let's suppose I'm taking a hypothetical situation. If the carrying amount of this property would have been 18 million, Not 19 million. 19 million. Then what would have happened? Tell me, if the carrying amount would be 19 million, then we will say that the gain on sale is how much? 1 million. The gain on sale is how much? 1 million is the gain on sale. 1 million is the gain on sale, and the rest 2 million is financial liability. So now what I'm trying to say here out of this is gain on sale. Gain on sale will be equals to fair value minus carrying amount. Fair value minus carrying amount, not sale price minus carrying amount. Not sale price minus carrying amount. Be very specific to this point. Okay, now since in this case carrying amount and fair value is the same, hence the gain on sale will be equals to nil. Hence it is equals to nil. That is 20 minus 20 is equals to 20 minus 20 is equals to nil. Okay, now when we take the asset back on lease, when we take the asset back on lease, so what we do, we recognize lease liability and ROU asset. Now how to recognize lease liability? Lease liability is recognized at present value of future lease payments. At present value of future lease payments, right? At present value of future lease payments. Present value of future lease payments. Now, what are future lease payments? So let's read the question. It says the lease payments are 1.25 million per year if stated carbon emissions targets are met in the previous 12 months period. If the carbon emissions are not met, the targets are not met, then additional 0.15 million has to be paid each year. It means what? Tell me what type of lease payment are these? What type of lease payment? We have discussed in our regular classes again. So this is nothing but in substance fixed lease payments, wherein a component of this lease payment is fixed and a component is variable, meaning thereby 1.25 million is the bare minimum amount that you have to pay every year. This is in substance fixed, and 0.5 million you will pay only if the targets are not met. Okay, if the targets are not met, then only you will pay additional 1.15 million. So this is variable. This is variable. Now tell me, what will we do for this one? So lease liability will be recognized at present value of 1.25 per annum for 10 years. For 10 years, and the remainder 0.15 million, whenever company pays on an actual basis, it is recognized in as rent expense. On an actual basis, it is recognized rent expense in P and L. Now, what is the present value of 1.25 million for 10 years? That is 9.3 million. 9.3 million is this one. Now, since the question is also saying that the lease payments are made in advance, so what is the amount of lease liability? So 9.3 is the present value of the future lease payments, right? So plus 1.25, the upfront lease payment that we have made, the lease liability becomes 10.55 million. 10.55 million. 10.55 million is the lease liability. Now, what is the amount of ROU asset? So we know that in case of sale and leaseback, we record ROU asset at carrying amount multiplied by lease liability by fair value. Now, what is the amount? What is the carrying amount? Tell me. What is the carrying amount? Tell me. So carrying amount is equals to 20 multiplied by lease liability is 10.55 divided by fair value is how much? What is the amount of fair value? Tell me. Fair value is 20. So what is the lease ROU asset? It is 10.55. It is 10.55 is the amount of ROU asset. So this is how you have to recognize. This is how you have to recognize the further. In addition to that, you have to say that subsequently on the same date, further, not subsequently, right? Further, on the same date, we will reduce lease liability by 1.25 million, because we have paid this much amount on the same day. So initially, first of all, we recognize the whole amount of lease liability, and then we pay off, this much amount. Okay, so this is the accounting treatment of sale and leaseback. I believe it is very much clear to all of you. Okay, now let's move on to the question number 1B. Using exhibit 1 and 2, discuss ethical issues arising from Bimal's instruction to Sami and explain how Sami should proceed. 10 marks. Okay, ethical issues. So this question is talking about ethical issues arising from Bimal's instruction to Sami. Who is Bimal? Who is Sami? We don't know. We have to read the exhibit. We will have to read the exhibit. Now, 2 professional skill marks will be awarded in part B for the relevance of the ethical issues and the actions identified and the clarity of the discussion. Okay, fine. So now what we are required to do is we have to go to this mail exhibit 2 and read what exactly is written here. Okay. But yes, we need to find out the ethical issues as part of exhibit 1 and exhibit 2 both. Okay. Now, so first of all, read exhibit 2. Bimal, the finance director of Gilliam, is an ACCA qualified and he has just returned to work after an extended period of leave. He has sent the following email to Sami, the finance manager. Okay. So now we are writing this answer on behalf of Sami or Bimal. Tell me, we are writing this answer on behalf of Sami or Bimal. Read the question and tell me. We are writing on behalf of Sami or Bimal, using exhibit 1 and to discuss the ethical issues arising from Bimal's instructions to Sami. Whatever instructions Bimal has given to Sami, what is the impact of that and how should Sami proceed? Tell me, we are helping whom? Sami or Bimal? We are writing on behalf of whom? Sami or Bimal? Sami. Very good. Now, so it says Sami, in respect of sale and leaseback arrangement, I think we should assume that the missing emission targets in 2007 was unusual. And since West Side was constructed in accordance with sustainable building guidelines, the target is highly likely to be met in all other years. I believe now see it is what is saying that West Side was constructed in accordance with sustainable building guidelines. But come to exhibit 1. So what is it saying? One of the Gilliam property West Side, which it leases to tenants, Gilliam built this property 2 years ago following the sustainable building guidelines recommended by the government. Subsequently, Gilliam has not followed these guidelines. Now, but here it is saying that we have followed the guidelines. We have followed the guidelines. So now tell me, do you think he is contradicting his own statement? He is contradicting his own statement, right? So this gives rise to what? This gives rise to what? Integrity issues. No integrity issues. Okay, further. I believe that this meeting is highly likely that meeting this highly likely threshold means that you should recognize the leaseback liability based on future lease payments of 1.25 per year rather than 1.4 million per year. This will keep Gilliam's finance cost to the minimum possible and help ensure. Now understand, though applying the IFRS 16, we are recognizing at 1.25 only. But ideally, he should recognize at 1.4, right? Ideally, he should recognize at 1.4, right? Because he is required to pay 1.4 million. So understand, when we are talking about lease liability, we will recognize it 1.25 only following the principles of IFRS 16. But understand why we are recognizing 1.25? Because of in substance fixed lease payments. Okay, that is variable. Now he is telling that we should own 1.25 only. We should recognize at 1.25 only rather than 1.4 because he thinks that we will meet the conditions. See, in both the case, the recognition will happen at 1.25 only. But the reason is different. Standard is saying to recognize at 1.25 because it is variable. He is saying 1.25 because he thinks that we will meet and you are not meeting now itself. So now this leads to what? This leads to what? Tell me. This leads to an issue of competence. This leads to an issue of creative accounting. This leads to an issue of creative accounting. Right now, further. Basis of recognition with wrong justification. Exactly. That's what is called as creative accounting. So I can write your point here. Basis and wrong justification. Now, further. This will keep finance cost minimum. So he just wants to reduce the cost to increase profitability. That is called as creative accounting. Okay. Now, self-interest rate. Very good point. But what is this self-interest? Is it mentioned anywhere? to help to ensure the debt service covenants put in place by the bank are met. Minimize cost. Okay, so now understand what is the meaning of self-interest. So self-interest means I am doing something for my benefit, for my personal benefit. Is Bimal having any personal interest in this one? Debt covenants to be met is for again for the company itself, right? It's not, there is no personal benefit, right? There is no personal benefit. So that will come under creative accounting. If you are doing for the benefit of the company, that is creative accounting. If you are doing for your own benefit, that will come under self-interest threat. Also, when you draft Gilliam's company sustainability disclosures, there won't be much to write about at all. Oh my God. Then again, you are doing here, it will, this point again gives rise to wrong disclosures. Wrong disclosures. Okay. So this wrong disclosures means competence. Competence, you are knowing that, see, it says that you are, don't have nothing to write, much to write, and you have already, you have not met the targets, and you are saying not much to write. I think most of the content should focus on the fact that Gilliam applies sustainable development practices. Again, give rise to integrity on sustainability. Again, gives rise to integrity issues on sustainability reporting. On sustainability reporting. Okay, as a result can access cheaper finance. Now, so this is what you have to write. Now further, but the question is not asking only to identify the ethical issues. The question is not only asking to identify the ethical issues, rather the question is also asking you to identify, explain how Sami should proceed. How Sami should proceed means the question is also asking you to say actions. Now, what are the actions that Sami should take? Tell me, guys. According to you, what are the actions that Sami should take? In according to me, Sami should, first of all, the point is Sami should discuss with finance director. Discuss with finance director. Okay, discuss with finance director. If that the what you are telling is wrong, okay, and let's follow correct accounting treatment. Discuss with finance director and suggest them the treatment which you are mentioning is wrong, and let's follow this and this. Okay, I believe he might understand. If he is unable to understand, then Sami should discuss with those charged with governance. Might be in some cases, in some companies, CFO and finance director are same. In some companies, in big companies, CFO is a higher designation than finance director. So then in that case, CFO becomes those charged with governance. Okay, CFO becomes those charged with governance. Now Harshita is saying disclose that substantial sustainability guidelines are not met, carbon targets are not met. Ideally, understand, ideally that is what is the correct treatment. But now tell me, does Sami has the authority, to do that? Tell me, do you think Sami has the authority without the permission of Bimal? No, right? So that's why we are saying no. In the actions we should write, we will discuss with finance director about correct treatment. If he is not understanding, we'll discuss with those charged with governance. If then also he is not understanding, he should take the documents and record everything. Take the documents and you can say a documentation. Take documentation, because he has the documentation of this mail, right? Take documentation of the email and facts proving that facts. Okay, and report to ACCA and consult for a professional advice. So this is how you have to write your answer. Is it clear, everyone? Is it clear, everyone? So 1, 2, 3, 4, 5, 5 plus 3, 8. 8 marks you have got. So and yes, in integrity, competence, you have to write 2 marks. Creative accounting, again, you can write 2 points. Competence, you can write 2 points. Integrity, you can write 1 point. Right? So these are the, so you can write definitely, there can be made around 12 points out of this one. But you have to write only for 10 marks. Is that clear, everyone? Come on, guys, tell me. Can you manage this one now? Can you manage this now? Tell me, please. Done? Wonderful. Wonderful. So that's all for the day. Heading for such threat needs to be made for professional marks, make headlines. So understand, headings we have to write. Headings we have to write. So it can, integrity can be in heading, competence can be heading. So there are two ways of writing heading, in my opinion. In my opinion, there are two ways of writing the heading. One way, one approach number one is write the headings as the trigger points. Trigger points means what made you think that integrity is getting impacted? What made you think that integrity is getting impacted? So you are writing the trigger points, okay? Or you should write the affected points, meaning thereby these are called as affected points. Okay, you can make this as the heading, you can make this as the heading, or you can write the trigger points as the heading. Okay, to give an example, either heading can be integrity, competence, creative accounting, competence, integrity. This can be the heading. Okay, now, or otherwise you can write the heading as sustainability building guidelines. This is the trigger point that you are not following it, but still telling that you are following it. This can be the one headline heading. So you have to select between these. You have to select between these. Okay, now for actions, you have to just write actions as the heading and then write 3 points under that. Okay, 3 right points under that. Now, so this is the way you have to write your answers on ethical issues and the actions that has to be taken. I believe this will give you a fair understanding of how to write the answer and how to deal with these questions. Okay, in the next session, we will discuss question number 3 and question number 4. Okay. Chalo. Okay. So in the last class, we were discussing question number 1 and question number 2 of pre-September mock exam, right? So today we'll discuss section B, question number 3 and question number 4 of the pre-mock. So let us discuss that now. Now, what is the approach that we take? So first of all, we read the introductory paragraph. That's my style, right? Now, after that, do we read the exhibits? No, we directly go to the requirements. We copy the entire set of requirements and paste in the word processor, and then read the requirements one by one, and then accordingly go to the exhibits according to the requirements. That's the approach that we follow. So now let's read. Edison Company is a parent company of the group. Financial statements are prepared in accordance with IFRS accounting standards. The group has a financial year end of 31st December 20x7. Okay, now, so this is very important. The financial year ending date is reporting date. Identification of the reporting date is quite very important. So let us identify that first. So the reporting date is 31st December 20x7. Now, the following exhibits available on the left-hand side of the screen provide relevant information. So there are two exhibits, share option scheme and investment associate. Wonderful. Now, rather than going to the exhibits, we will directly go to the requirements. Now, rather than reading the requirements now, we will directly copy paste the entire set of requirements, close it, open word processor, paste it. This basically enables us to navigate in a better manner. Okay, that's the approach, that's the thought process. We can copy one by one as well, but this helps us to navigate in a better manner. Okay, so these are the four requirements. These are the four requirements. So now what we'll do is we'll first read the requirements and accordingly we'll answer the questions that follow. So using exhibit 1 and in accordance with IFRS accounting standards, okay, requirement number 1 says explain with calculation. So basically it means explain, you have to explain, you have to give the theory, plus you have to calculate as well how Edison company should account for the share options scheme and the related deferred tax in the console statement of console financial statements for the year ended 31st December 20x7. That's the reporting date. 31st December 20x7 is the reporting date. Okay, now, So let us open the first exhibit number 1, and try to answer that follow. So it says, let's read the question again. It says, explain with calculations how Edison companies should account for the share option scheme. See, the requirements are, what are the requirements? So let us understand the requirement first of all. The requirement is asking for, the requirement is asking you the accounting treatment of share option expense, share option scheme, share option scheme, and then the accounting, then it is also asking you the accounting treatment of deferred tax related to share option scheme, right? So now the total is of 12 marks. So we can very well say that this can be for 6 marks and this can be for 6 marks. Tell me, clear everyone? Come on guys, tell me, clear everyone? Now, the question is also asking you that when you're explaining the accounting treatment, you have to explain with calculations. So now can we say that 3 marks is for explaining and 3 marks is for calculation, right? Very fairly, like we can break this. Now, similarly here also 3 marks is for explaining and 3 marks is for calculating. Now, so this is how it is distributed. The allocation of marks is distributed. Okay, now let us try to write the answer. So first of all, what we'll do is we'll calculate the expense. So for calculation, we'll go to the spreadsheet. For calculation, let's go to the spreadsheet. It helps us calculate in a better manner. We can do our calculation in the word processor as well, but it's better to solve in word processor. Spreadsheet. The calculations should be done in spreadsheet. Now you can write here part A, the answer. Now let's read the exhibit and then solve it. On 1st January 2006, on 1st January 2006, Edison implemented a share option scheme for its managers. Each of the 200 managers were granted 10,000 share options that vest on 31st December 2008. So the grant date was 1st January 2006 and the vesting date will be 31st December 2008. So meaning thereby 6, 7, 8. The vesting period is 3 years. The vesting period is 3 years. The exercise price of the option is 8.5, and Edison will benefit from tax relief on the transaction when the share options are exercised based on intrinsic value of the share options. On 1st January 2006, the fair value of the share option is 2.8. So this fair value is the fair value on the grant date. This is the fair value on the grant date. So let's highlight it. Let's highlight it. This is the fair value on the grant date. So let's highlight it. Fair value on the grant date. So we'll need this value. We'll need this value. Okay. Now, on 31st December 2007, the fair value of one of the Edison shares is this much. We don't need it. Okay. On 31st December 2007, it was expected that 90% of the shares would vest. Okay. Now, can you please tell me what will be the expense and SBP share-based payment reserve for the year ended year ended 31 December 20x7. Now, the options were issued or granted on 31st January 20x6. So definitely we can say the expired period is 2 years out of 3 years. So now what we can do is first tell me what is the cumulative share-based payment reserve. So it is equals to 10,000 share options. So first of all, let's write in this way: 10,000 share options multiplied by how many employees? 200 employees, and out of which we expect that 90% will vest. So multiplied by 90 percent multiplied by 90%. Okay, so these are the number of options that will vest. Now multiplied by 2.8, multiplied by 2.8 is the fair value on the grant date. Now this is the total expense, but we have to book into 2 by 3. So this is what we have to recognize. Now this is the total cumulative expense that has to be booked till year end 2, that is till 31st December 20x7. Done. Now that's SBP reserve as on reserve as on 31 December 20x7. Now the question says in the year ended 31st December 20x6, Edison correctly recognized a share option of this much. So you have to write less expense less expense recognized in 20x6 is how much? It is 1792,000, 1792,000. So what is the expense that has to be recognized in the current year? So this is this much. Now tell me, is that clear, everyone? Is that clear, everyone? I think this is what we have studied as well in our classes, right? Now, so this is the expense that has to be recognized. Further. So this is from the perspective of expense, and this is from the perspective of SOFP. This is what will be recognized in SOFP. This is what will be recognized in P and L. Sorted. So with this is the treatment of share-based payment. Now we also need to discuss about the tax, right? So we also need to discuss about the tax. Now, what is the deferred tax implication? Now, as you know that this is a reserve is an equity part. It is an equity part. For equity, did we discuss how to calculate the carrying amount, how to calculate the tax base of an equity? Tell me, did we ever discuss that perspective that this is the tax base of an equity? No, we didn't discuss, right? Because equity doesn't have any tax base. So how to identify the temporary difference? Because if we don't know the temporary difference, we won't be able to identify the deferred tax asset or deferred tax liability. Now, so if you can recall, we discussed in our regular classes that for a share-based payment to be settled in equity, the temporary difference is the, tell me what is the amount? The temporary difference is the amount of future deductions available from this share-based payment scheme. Now, calculation of deferred tax. Calculation of deferred tax. So comes the question, what is a temporary difference? Temporary difference. So temporary difference is equals to future deductions. Future deductions. So what is the deduction that is available in the tax books in the future when these options are exercised? So now tell me. So it says Edison will benefit from the tax relief on the transaction when the share options are exercised based on intrinsic value of share options. So it's standard. The question is saying, the exhibit is saying that we'll get the deduction based on the intrinsic value. Now comes the question, how to calculate the intrinsic value? So it says the intrinsic value is the difference between exercise price of the share option and the fair value of the share, right? So now what is the this one? So let's write here. Copy, paste. So what is the intrinsic value? What is the intrinsic value? 90%. And what is the intrinsic value? Intrinsic value is how much? So first of all, let's calculate intrinsic value. Intrinsic value at 31 December x7. The difference between exercise price and fair value of share. So what is the fair value of share on 31st December 2007? The fair value of one Edison share is this much on 31st December 2007. This is the fair value. So it is 11.5 right here is equals to 11.5 minus 11.5 minus what is the fair value of share minus exercise price. What is the exercise price? 8.5. Exercise price is 8.5. Right? Make sense? Make sense? So multiply how much it is? It is 11.5 minus 8.5 is equals to 3. So right here, let's write here 3 multiplied by 3 multiplied by 3. So how much? How much? Copy equals to value. Right? But now tell me, this is for the entire, but we need only for 2 years. We need only for 2 years. 2 by 3. So let's multiply 2 by 3 into 2 by 3. This much is the amount of temporary difference. Now tell me, is that clear, everyone? Is that clear, everyone? Now tell me, this temporary difference will lead to what? This temporary difference will lead to what? This temporary difference will lead to what? It is deductible or taxable. So you have to write this temporary difference is a deductible temporary difference. So this writing part, explaining part, I'm not doing here. I'm just doing the calculation part first of all. Okay. Now, so this is a temporary difference, which is a deductible temporary difference, and hence it will give rise to a deferred tax asset. Now comes the question, sir, how did you conclude that it is a deductible temporary difference? Because it will give rise to future deductions in the future, which will reduce my taxable profit, which will reduce my tax liability, and hence it is a deferred tax asset. Now, so deferred tax asset means tax rate is 25%. So 25% is this multiplied by 0.25 is 9,000. 900,000 is your deferred tax asset. Tell me, is that clear, everyone? Is that clear, everyone? Come on, guys, tell me. So if you do this much, you have fairly scored 6 marks in this part A. You have fairly scored 6 marks, 3 marks for this one and 3 marks for this one. Fairly, you have scored 6 marks out of this one. Now, closing this part, now coming on to the accounting treatment of share-based option scheme. Now, so how will you write the answer now? Be direct. See, understand, guys, one approach you always need to understand. What happens in the exam is we are always trying to write a perfect answer. There is no perfect answer for SBR. Okay, directly come to the point and write your answer, move on to the next answer. I have always said this, and I'll again repeat it now, that writing 2 perfect or 3 perfect answers, okay, always prefer to write 4 average answers rather than writing 3 perfect answers. Because even if you try to be perfect, you will never be perfect. First point. Okay, your answer will anyways be going to be average. Okay, but we will try to be perfect. So don't try to be perfect also. It is okay to be average. It is okay to be average. Okay. Because we take unnecessary load of being perfect, writing a perfect answer. Don't try to do that. Okay, you are not going to score much marks. I have seen students who have just written their answers casually, and they have, yet when I say casually, it doesn't mean that they are writing wrong treatment. They are writing correct treatment, but they are just writing what is asked, not even one line extra or one line less. Just whatever is asked, I'm writing that, moving on to the next part, done. Okay, now further. So now what is accounting treatment of? So now you have to say this is a equity settled share based scheme. Okay, and entity needs to recognize an expense, recognize proportionate expense with a corresponding increase in equity, or you can write increase in SBP reserve. That's what we have discussed, right? SBP reserve, or you can write in the bracket equity, whatever you, if you're writing equity, that is also correct. If you're writing SBP reserve, that is also correct. Okay, so now, so this is the first statement that you're writing now. So further entity, now you just need to explain the calculation, that's all. You just need to explain the calculation, that's all. Entity needs to take the best estimate, need to consider need to take the best estimate of a number of options that will waste at the end of the vesting period. At the end of the vesting period, okay. Hence we considered 90% of the employees. Okay. Now further you have to write expense recognized for current year. For the current year is how much? What is expense that we recognize for the current year? Tell me what is the amount? Amount, tell me guys, come on. Spreadsheet. It is 1568. 1568 is 15.68 million, which will increase SBP reserve as well. Done. Now tell me anything else that we need to write? Anything else that we need to write? Right? This expense will be recognized as part of employee benefit expense, and SBP reserve being recognized as other components of equity. Done. So now tell me, is it something difficult? Is it something difficult that you don't know to write? Tell me. Is it something difficult? Come on, guys, tell me. I believe these are the bare minimum treatments that we discussed in the first class of share-based payment, right? That we discussed in the first class of share-based payment. Now, coming to accounting treatment of deferred tax. Accounting to deferred tax. Now, directly come to the point. Directly come to the point. Okay. Share for equity settled share based payment, there is no tax base that we calculate. There is no tax base that we calculate. Hence, temporary difference is calculated as future deductions available. Bracket mein, if any. Now, in this case, future deductions future deductions is what is the future deductions? Now see, is based on, just copy from here to here. Just copy it. Copy, paste. Paste. Future deduction is based on this one. Okay, done. Now, hence, intrinsic value is dollar 3.6 million, which leads to a deferred tax asset of how much? 0.9 million. Now further, now tell me, 3 points we've written fairly here. Is it clear, everyone? Tell me, is it clear, everyone? We need to write one more point. Can anyone tell me what is that point? We need to write one more point. If you have fairly revised your chapter of deferred share-based payments, you will be able to answer. If you can compare this, if anyone can compare this with this and tell me what exactly is the one more point that we need to write. No. What is the one more point that we need to write? So we need to write further, if cumulative expense further if cumulative expense recognized in PL in tax books okay is exceeds right, not right, exceeds cumulative expense recognized in a P&L, the tax effect for the difference is to be recognized in equity rather than PL. Done. Tell me, is it clear, everyone? Is it clear, everyone? See what I have done. I have written 3 points for this one, 4 points for this one. 3 plus 4, 7. You can skip any of these points. Okay, you can skip. You can still shorten your answer. I have written still a lengthy answer. You can still shorten this answer. Tell me, is it clear, everyone? This is the answer for 12 marks. Come on, guys, tell me. All of you, is it clear? Can I move on to next question? Can I move on to next question? Now, Isita, this will resolve your query of conceptual framework as well. See, this question is coming from conceptual framework. This question is coming from conceptual framework as well. Now, so it says critically discuss whether the deferred tax balance recognized in relation to share option scheme reflects the definition of elements provided in the conceptual framework of financial reporting. Right? Now tell me, first of all, tell me, the deferred tax recognized for share option scheme is a deferred tax asset. It is a deferred tax asset, right? Definitely conceptual framework does not talk about deferred tax, but the conceptual framework talks about recognition of an asset, right? But the conceptual framework talks about recognition of an asset. Tell me yes or no. Come on, guys, tell me. Now tell me, as per conceptual framework, as per conceptual framework, what is the definition of an asset? An asset is recognized, an asset is recognized as, or asset is defined, you can write asset is defined, an asset is defined as a present economic resource, which will lead to inflow of resources embodying economic benefits. Right? Tell me yes or no. This is the definition. This is the definition of an asset as per conceptual framework. Guys, you are there. Okay, controlled by entity. Okay, and controlled by entity. Okay, take it, done. Cool. Now, well, this is the definition of an asset as per conceptual framework. But now, do we recognize deferred tax asset on this line? Do we recognize deferred tax on this line? Tell me, deferred tax asset, is it a present economic resource? Tell me, is deferred tax asset a present economic resource? No. However, deferred tax asset is not a present economic resource, as it will be recovered, if condition, if entity is able to get the deduction from its future future taxable profits, hence there is a conflict between IAS 12 on deferred tax. Don't write standard. There is a conflict between deferred tax asset and uh, conceptual framework. Now, if there is a conflict, tell me, what shall we do? Tell me. If there is a conflict, what to do? Now, in case of conflict, entity needs to follow the relevant accounting standard on deferred tax. Done. Oh yeah. Follow IFRS standards. So this is how you have to write this question on conceptual framework. So now, Isita, are you understanding what is the approach that you need to take for writing a question on conceptual framework? So first of all, identify. See, it is saying about the elements, right? Definition of elements. Elements means what? Asset, liability. So you have to understand what are the components of financial statements and what are the elements of financial statements. So components means SOFP, SPNL, SOCIE, notes to accounts, cash flows. But elements means what? Assets, liabilities, incomes, expenses, and revenue. Okay, yes, you can write that point also. Okay, so we do have a lot of points, but since it is only for 4 marks, so I have written fairly this much. Okay. So now tell me, Sita, are you getting the understanding? Are you understanding how exactly to write the answers on conceptual framework? Again and again, I'm trying to emphasize, don't try to be a perfectionist. Okay, so I always say this in paper of SBR, don't try to become Amir Khan. Try to become Akshay Kumar. So what Akshay Kumar does? Fastly finishes the movie, does another movie. Similarly, fastly finish a question, do another question. Fastly finish the question, do another question. Don't get stuck up in one question trying to make it perfect. No. If you have time remaining after attempting all the questions, definitely then you can spare, then you can apply those time to make your answer perfect. But till the time, no. The SBR is all about new questions, but you need to have confidence on yourself that you know the standards. Tell me, Sita, you know the standards, right? Do you have the confidence that you know the standards very well? Do you have this confidence? Then I can guarantee that you will clear SBR with that too with good marks. This is my personal guarantee I can give you. But yes, only condition that you have confidence on standards and you have practiced questions. Okay. So it's not the case that you should know every question, no, but you should know how to think around this question, like a conceptual framework question, like an investor question, like a question on ethics, like a question on group accounting, like question on pre-populated screen. So you need to have an approach for that. The more you practice, the better you become. But you can't think of a situation wherein you have practiced all the questions and you will now think that, okay, a similar question will come in the exam. No, that's not going to happen. That is not going to happen in SBR. If you practice 1000 questions also, then also in the exam you will get 1000 plus one question. Okay, so you can't expect a similar question in the exam, never. So this is done. Now this is all about exhibit 1. Moving on to exhibit number 2. moving on to exhibit number 2. Yes, before moving on to exhibit number 2, guys, I want to say one thing to you guys, that have you seen a video that I have made for you guys? Two videos, two videos. Particularly, I said three videos. One is the sustainability. I believe all of you have seen that sustainability. That is a very important. If you have not seen that, please go and watch that. Second is the treatment of dividend in group accounts. And the third is the mistakes, commonly made mistakes in the group accounts. Okay, I have tried to identify all the mistakes by so what are the sources that I've used to make that video? I'll tell you. So I have referred all the questions of FR, all the questions of SBR of group accounts, technical articles, and past papers, examiner report. All the things I have referred, whatever can be done, I've done, and tried to make, I have identified, I believe, so around 28 to 29 mistakes. And each of these 28, 29 topics have subtopics also 4 to 5. So if you get a grip over this video, definitely I can say it with confidence that definitely you are not going to make a mistake in the chapter of group accounts. How many? 25. And each of them have like major 4 5 subparts, 5 subparts. So in total I can say around 30 to 32, 30 to 35 mistakes I have listed. So if you watch that, definitely it will be of great help for you guys for group accounting. Okay, now moving on to this part. So it says, using exhibit 2 and in accordance with IFRS accounting standards, explain how Edison should account for its investment in Lipton and the related deferred tax in the console financial statements. Again, so you have to write two things. You have to write accounting treatment of investment in LUPTON, accounting treatment of deferred tax on investment in Lipton. Now, so it is 6 marks. So again, 3 marks. 3 marks. Sorted? Is the life sorted now? Is the life sorted now? Now, so first of all, let us open exhibit number 2. Exhibit number 2, investment in associate. Oh my God, investment in associate. Investment in associate. So let's read the exhibit first of all. It says what? It says that on 1st September 2007, Edison Company acquired 40%. If nothing is mentioned, we will assume that it is an investment in associate. Okay, now for 13.9 million, this being the cost, this being the cost. Okay, now on this date, the fair value of the Lipton identifiable assets and liabilities was $38 million, which was equal to the carrying amount in Lipton individual financial statements. Edison has a representation on the Lipton's board of directors and has determined that Lipton is an associate. Now, Edison has representation on board of directors. Does it say has majority on board of directors? Tell me. Representation means what? Power to participate in decision making, power to participate in decision making, power to participate in decision making. Now, and has determined that Lipton is an associate. Lipton is an associate. Edison participates in operating and financial decisions about Lipton. Okay, participates, but does not determine the company's dividend policy. Basically, does not have decision making, but has power to participate. So this proves that it is an estimate. This proves that it is an associate. We are not required to subsequently prove it. It is already proved now. So now in the year ended 31st December 2007, Lipton made profits of this month. So it is for the entire year. It has made a profit of 5.1 million. But when have we acquired? Tell me. We have acquired on 1st September. It is for the entire year. So we definitely need to take the proportionate of it. Okay. And had no comprehensive income. Relevant tax rate is this much. If it disposes of the investment in Lipton, it will receive tax deduction. Means it is the tax base of investment in associate. So now we need to write about it. So first of all, do one thing. Let us do one thing. Let us do the calculations part. Let us deal with the calculations part. And then subsequently, we will do the explaining part as well, right? So once the calculation part is sorted, explaining part is quite very easy to do, right? That's how I do things. So first of all, let's do the calculation part. So let's do the calculations. So this is part B now. Part B. Part B. Now, in part B, what will happen? So what is the cost of investment? Tell me now. What is the cost of investment in associate? What is the cost? So cost is 13.9. Cost is 13.9 million. Oh, 13,009. 13.9 million. 13.9 million is the cost. Okay, now on this date, fair value is this much. Okay, ठीक है, fine, let it be. Now, addition has a representation. Now, what is the share of profit? Post acquisition share of profit. What is the post acquisition share of profit? So the post acquisition share of profit is how much? So it has earned a profit of 5.1 million in the entire year. But when did we acquire? 1st September, September, October, November, December. So multiplied by 4 by 12, multiplied by 4 by 12, multiplied by 4 by 12. Now multiplied by 40%. Clear, everyone? Right? Similarly, we'll write here as well the same thing, equals to 5.1 into 4 by 12 into 0.4 is 0.68. Right? So this gives you the closing balance. Okay. Investment in associate is how much? Equals to this plus this, 14.58. Anything else? Anything else? No, right? Okay. Now comes the question. Let's calculate goodwill. Let us calculate goodwill. Goodwill on investment. Do we recognize goodwill? Do we recognize goodwill on investment associate? Do we recognize goodwill? No, but we definitely disclose, right? We definitely disclose. So we say, what is the investment? What is the value of investment? So investment is valued at 13.9. Investment valued at 13.9. What is the proportionate share of net assets? The proportionate share of net is 38 million. 38 million multiplied by 40%. 38 multiplied by 40%. Okay, so how much it becomes? Equals to 38 into 0.4. That comes to 15.2. Oh my God, is it a goodwill? Is it a goodwill? No, it is not. It is not a case of goodwill. It is not a case of goodwill. It is a case of bargain gain. Gain on purchase. It is a case of gain on purchase. It is a case of gain on purchase. What is the amount? What is the amount of gain on purchase? What is the amount of gain on purchase? So it amounts to 15.2 minus 13.9 is 1.3. Tell me, is that clear, everyone? Is that clear, everyone? Now, then in this case, what is the journal entry? What is the journal entry? Though I don't want to write journal entry here, but okay, let me write the journal entry here. What is the journal entry at the time of initial recognition? Can you tell me? What is journal entry at the time of initial recognition? Can you tell me? So it is investment in associate account debit to bank. Bank is how much? So let's say debit, credit is how much? 13.9 is the bank amount. 13.9 is the bank amount. Okay. Now, to gain on purchase. So whenever it is gain on purchase, we need to recognize that. But whenever it is case of goodwill, we just need to disclose that. And that is also one of the common mistake which a student does in the exam, and which I have discussed in detail in my mistakes video. Again, I have discussed that part. Okay. So now, so this will credit by what amount? Will credit by what amount? 1.3, 1.30. 1.30. So this will make my value of investment as how much? 15.20. 15.20. So now here my calculations will change. My calculations will change. So now here I need to include one line item. We need to include one line item stating gain on purchase. Gain on purchase. At what price? 1.30. That comes to now. What is the value of investment now? This is equals to sum. This is equals to sum. This plus this plus this is 15.88 now. This is the value of investment in associate. This is the value of investment in associate. Is that clear now? Tell me, guys. Is that clear now? Tell me. If there is a loss on purchase, now there is no concept of loss on purchase, Priti. So if this figure, see, since this figure is a negative figure, it is a negative goodwill called as gain on purchase. But if this figure would have been positive, it is called as goodwill. There is nothing called as loss on purchase. It is called as goodwill. That loss is called as goodwill. We have paid extra, meaning thereby we expect to receive extra benefits in the future. Whenever we acquire any company, we always pay extra. Why? Because we expect to receive benefits in the future. And that is called as goodwill. It is not called as loss on purchase. It is called as goodwill. Okay, so now goodwill is not recognized, Priti. Goodwill is disclosed in the financial statements. Goodwill is disclosed, but if it is a case of gain on bargain purchase, then yes, we have to recognize in the case of associate. In the case of associate, we need to recognize that. Compare investment with the proportionate share of net assets, with the proportionate share of net assets. Compare investment with fair value of net assets or carrying amount with fair value of net assets. See, it is given here. The fair value of net assets. Fair value. On date of acquisition, fair value. Fair value on date of acquisition. Proportionate share of, let me write here, fair value of net assets on date of acquisition. On DOA. On date of acquisition. Clear? Clear? In this question, fair value is equal to carrying amount. Where? So it is given, no, on this date, fair value is given is this one, which was equal to carrying amount. Huh? Fine. So if it is same, it's fine. We are required to do at fair value. If the question says fair value is equal to carrying amount, good. Okay, now, so this is what it is, the treatment now. So this is a normal treatment. Now comes the deferred tax. Deferred tax. Now for deferred tax of now tell me, investment in associate is what? Investment in associate is what? It is an asset, right? So now for asset, we have discussed the carrying amount and the tax base, right? And we can calculate temporary difference, and we can accordingly calculate deferred tax asset or deferred tax liability. Now for deferred tax, so what is the carrying amount of investment? What is the carrying amount of investment? What is the carrying amount of investment? The carrying amount of investment is 15.88. It is equals to 15.88. But what is the tax base of investment? What is the tax base of investment? What is the tax base of investment? It is 13.9. Can anyone explain me why it remained at this cost itself? Why didn't the tax base increase? Because in the accounts books, we have recognized this gain or bargain purchase. We have recognized this post acquisition share of profit. Since they are not a cash flow item, since they are not yet realized, on an accrual basis, we are recording this gain or loss. On an accrual basis, we are recording this post acquisition share of profit. But did we realize it? Tell me. Did we realize it? No. So there is no adjustment done in the tax books. So in the tax books, the investment remained at cost only. So now when this temporary difference be recovered, when we will sell the investments, then it will be recovered. Very good, very good. Okay. Or when we receive the dividend, whenever we receive the dividend. Why? Because see, understand, when we receive dividend, what will happen? The carrying amount of investment will get reduced, right? And temporary difference will get reduced. Are you understanding this part? Now, what is the temporary difference? What is the temporary difference? So temporary difference is equals to this minus this is 1.98. Now, can anyone tell me if this temporary difference is a taxable temporary difference or a deductible temporary difference? Now, as I've always said, that carrying amount of an asset is means future economic benefits. Tax base of an investment means tax base of an asset means future deductions. So if the future benefits are greater than future deductions, means temporary difference means future benefits. Okay, future benefits. If we have future benefits, you will have to pay tax on that. So it becomes taxable temporary difference. It becomes taxable temporary difference. Okay. Now, and hence you have to recognize a deferred tax liability at the rate of 25%. That is equals to how much? It is this multiplied by 0.25 is equals to 0.50. Tell me, clear everyone? Clear everyone? Is the question giving any other information about associate? Any other information? No. 1.98 into 0.25 is 0.495. It's not 50. It is equals to custom. Let's write custom. Okay. And number. See all. Okay, ठीक है. So what I'll do is I'll write in amounts. I will write in amounts. 4950 is the amount. Okay. Absolute figure. This is an absolute figure. This is an absolute figure. This is an absolute figure. This is not in millions. Okay, absolute. Tell me, clear everyone? So now this is what you have to explain again here. This is what you have to explain again here. Now, can you tell me, can you explain it? Can you explain it? So how will you explain? So first of all, you will explain it like this. First point you have to explain like this, that since directly jump to the conclusion. Since, okay, I'll come to the this one. This one required 80% Lipton. Okay, and copy. And Edison has a representation on the board. New policy. It has significant influence and can be and is an associate Directly jump to the conclusion. Okay, done. Now first paragraph done. Second, investments in equity, investments in associate is to be measured at equity method. It is to measure at equity method, right? Now, then further, what will you write? If fair value, okay, if investment is less than proportionate share of net assets, then the differential is to be recognized, in investment, recognized as an addition to investment in associate. That's all done. And then you have to explain this part. Okay, further, equity method you can explain under equity method. You can explain this part also subsequently in equity method. So, subsequently, you can write here what you subsequently in equity method. entity needs to recognize share post acquisition share of profits. Okay. Then you can show the calculation of this post acquisition share of profits spreadsheet, where it is this part. Yeah, this part. Copy as equals to this. Oh no. Copy, paste, equals to 5.1 multiplied by 4 by 12 multiplied by 40%. Okay. Now, this will be recognized in P&L, a single line item, and also in SO, and also added to balance of investment in associate for SOFP. Done. Tell me, am I writing anything out of the box? Am I writing anything out of the box? Tell me, guys, come on. No, I don't think so, right? I'm writing simple and plain answers. Nothing difficult, nothing complex. Now, accounting treatment of deferred tax on investment in Lupton. What is accounting treatment of deferred tax? Now, for deferred tax, you need to write, we need to, now you have to write, there arises a temporary difference. Why there is a temporary difference? Because post acquisition share of profits are not accounted for in tax books, as they are not yet realized. Hence arises a temporary, a taxable temporary difference. Okay. Now, so this is a taxable temporary difference that arises. So you have already shown the calculation. So now temporary difference of what amount? Of 1.98. Therefore, a deferred tax liability of 4950, that is 1.98 million multiplied by 25%. 1.98 million, right? So it is how much? 1.98 into 0.25 is 0.495 million. You write here 0.495. 0.495 million is to be recognized. Okay. The corresponding difference, the change in deferred tax liability is to be recognized, not the change, right? The increase in deferred tax liability. The increase in deferred tax liability is to be recognized. Tell me, where will we recognize this increase in deferred tax liability? P&L or OCI or equity? Tell me where. P&L, OCI or equity? Tell me where. P&L, OCI or equity? Tell me where. Come on, guys, tell me. In P&L. Why? Because the corresponding profit also goes to P&L. Applying matching concept. You can write here, applying matching concept. Why? As the corresponding gain is also recognized in PL. Done. So we have fairly discussed these points, right? So I can say that these are also very high level answers. Okay. You need to just write to the points, move to the next answer. That's all done. That's all done. Now, moving on to the next part. Critically discuss whether the deferred tax balance, again, same thing. Now tell me, deferred tax balance for investment is what? Deferred tax balance for investment is what? It is a deferred tax liability. Now, what is the meaning of deferred tax liability? Okay, or what is the meaning of liability? What is the meaning of liability as per conceptual framework? So, as per conceptual framework, so it is a present obligation. It is a present obligation arising out of past events, arising out of past events, which will be settled by delivery, okay, or outflow, settled by outflow of resources embodying economic benefits. Now tell me one thing. Does deferred tax liability is present deferred tax liability a present obligation? Is it a present obligation? Tell me. Do you think it is a present obligation? No, it is not a present obligation. It is not a present obligation. It is not a present obligation. Okay. Now, hence there is a conflict. Now, if there is a conflict, standards will prevail. Standards prevail. Standards prevails. Done. So this is how you need to write your answers. This is how you need to write your answers. I believe you are able to understand. I believe you are able to understand the thought process. One more tip to you guys. In SBR paper, okay, in SBR paper, try to write 100%. Okay. Why specifically? Because if you're not writing any answer, anyways, you're not scoring marks for that. But if you write your answers to the level of knowledge that you have, at least you will score some marks in that. Okay. At least you will score some marks in that. So don't think that, oh, I don't have the knowledge of it, so I'll not write. Don't do that. Okay. If you have time remaining, do write. Definitely give preference to the answers that you know better. Once you're done with those questions, then don't leave the other questions. If you have time, don't leave other questions. Try to opt for 100%. It is not a okay. Deferred tax liability is not a present obligation because it will arise in future. It will arise in future when basically when the taxable temporary difference reverses. It is then it will arise. It is not a present obligation. Okay. Now, so this is your question number 3. Moving on to question number 4. Moving on to question number 4. Now, what exactly is being asked in question number 4? So let's read the question first of all. Fuller operates an online food ordering platform. It prepares financial statements in accordance with IFRS accounting standards. The company has a financial year end of 31st December 2007. The following exhibits available on the left hand side of the screen. Okay, now they are the two exhibits, food ordering platform and the technology, the information used. Okay, now, so what we'll do, we'll first open the requirements. We'll copy the entire set of requirements. We'll copy the entire set of requirements, copy, close the requirement window, open the word processor, paste the requirements here now. So these are the 3 requirements in the question. These are the 3 requirements in the question. So now let us read the requirement one by one and refer to the exhibits that follow. Using exhibit 1 in accordance with IFRS 15, revenue from contract with customers. Explain how Fuller should account for the revenue from the sale and delivery of the Go Pizza food ordered for food ordered on the fullerfood.com platform in the year in 31st December 2007. So what is it says? Using exhibit 1 and in accordance with IFRS 15 revenue recognition, What you have to do? First point. Requirement number 1. It says explain how Fuller company should account for revenue from sale. How revenue should be accounted? How should account for revenue? How it should account for revenue from the sale, and delivery of Go Pizza food ordered on the fullerfood.com platform in the year ended 31st December 2007. How the revenue should be recognized. So let's us read the exhibit. So this is Go Pizza. Now, Fuller operates an online food ordering platform, fullerfood.com, Go Pizza, on 1st August 2007. Our year end was 31st December 2007. So it says on 1st August 2007, Fuller entered into a contract with a restaurant, Go Pizza, to add to its menu to the fullerfood.com selling platform. So it says on 1st August, Fuller entered into a contract with a restaurant. Okay, Fuller is a basically you can say Zomato. Fuller is Zomato. Enter into contract with the restaurant Go Pizza. Okay, Zomato enters into a contract with Domino's to add to its menu Zomato app selling platform. Customers make an order using the Zomato app website, and then the Fuller passes all the order to Domino's. Okay. Now, are you able to understand the scenario? Are you able to understand the scenario? Tell me, guys, come on. This is exactly a Zomato scenario. This is exactly a Zomato or a Swiggy scenario. The food, when the food is ready for delivery, it is collected by the Fuller's delivery drivers and delivered to the customer. The customer is charged the price of the food ordered plus a delivery fee. Don't you think it is exactly a scenario of Zomato or a Swiggy? Come on, guys, tell me. Right now, the customer pays using the online payment system. Go Pizza sets the prices. Go Pizza sets the prices of selling price of the food options on its menu. Fuller transfers 95% of the selling price of the food to Go Pizza when the delivery is complete. Some customers choose to collect the order from the restaurant themselves rather than having it delivered. In this case, customer pays no delivery fee. So we do have an option to directly go to the Domino's store and purchase pizza and come home, right? So in that case, we are not required to pay any delivery fee. In the period from 1st August to 2007 to 31st December, the total amount charged to customers that ordered from Go Pizza was this much, and out of which 21,000 related to the delivery fees. Now understand. So now, first of all, tell me what student makes a mistake here is they go and they try. What student makes mistake here is they write all the 5 steps. Oh, step number 1 is this. Step number 2 is this. Step number 3 is this. Step number 4 is this. Step number 5 is this. In this case, this is a scenario of step number 2. No, 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 not required. Not required. Not required. Directly write your answer. Now tell me. In this case, first of all, you have to identify what the 5 steps run through has to be done, but that run through has to be done in your mind. You are only required to write the affected step, not all the steps. Step 1, there is a contract. Is there a contract? Yes, there is a contract. Now, step 2, performance obligation. Tell me, how many performance obligations? There are, I can write, there are 2 performance. There are 2 performance obligations. There are 2 performance obligations. Okay, there are 2 performance obligations, namely performance obligation number 1, performance obligation number 1, sale of food, and performance obligation number 2 is delivery. Now, what is the transaction price? What is the transaction price? 120,000. Okay, 120,000. But now let us first of all allocate the transaction price. So the transaction price charged is 120,000. This is step number 3. So understand, this is step number 2. This is step number 3. But am I writing all the steps, or am I specifically writing the name of the step? No, I'm just writing the affected part. That's all, nothing else. Now comes the allocation. So specifically it is allocated. Now if it is specifically allocated, will I go and allocate again? No. So out of which out of which you have to say that 21,000 is for PO2, that is delivery, and remaining that is 120,000 minus 21,000, that is equals to 99,000, is for PO2, sale of food, right? Right. Now comes revenue recognition. But before revenue recognition, let us understand the business model. So now let's write here for PO1. What you will write? Tell me. For PO1, since Fuller is just collecting orders from customer and fulfilling orders, just collecting orders from customer and passing it to Pizza, and does and Fuller does not establish prices, and Fuller does not maintain inventory. Hence, Fuller is acting as an agent here, okay, and should recognize net amount, that is 5%. Why? Because 95% is transferred to GoPizza. 5% as revenue, why? Because, write in the bracket, because 95% is passed on to GoPizza. Okay. Revenue to be recognized is equals to how much? 99,000 multiplied by 5% is equals to how much? 99,000 का 5% is how much? 4,950. Tell me, is it clear, everyone? Clear, everyone? Now, this is the revenue to be recognized. Now, further, for PO2, delivery is the primary responsibility that Fuller has, and is acting as a principal, hence should recognize entire amount as revenue. Revenue to be recognized, copy, paste. Revenue to be recognized is equals to 5,000. No, 21,000, sorry. Is 21,000. Therefore, total revenue to be recognized for financial year ended 31 December X7 is equals to 21,000 plus 4,950 is equals to how much? 25,950. Done. Is that clear, everyone? None. Now coming on to next part. Reasons for PO2. Reasons for PO2. Because it is clear, no. See, it is a delivery partner. It is written, no, delivery partner. Reasons for two POs. Okay. Where it is written. Okay, okay. Yes, you can write here. Yes, that's again one point that you can write here. Very good, very good. So we can write here why. So we can have to write these two promises are distinct. These two promises are distinct. Why they are distinct? Why they are distinct? Because directly come to the conclusion. Because now come to the question and write here. Okay, sorry. Copy. Right here, then meaning thereby that customers can purchase pizza separately, and there is no there is no relation, between two promises. Done. So again, one more point. Yes, one more point we do have it. Right. So this is what we can write as an answer. Tell me, clear? Clear, guys? Now coming to the next point. Explain the accounting implication, if any, when the vouchers are issued to customers. Okay, discount vouchers. Now tell me what I have discussed with you for discount vouchers. So we say that discount vouchers are a separate performance obligation, and has to be recognized as a liability on issue, and recognized as a revenue on either redemption or lapse. Okay, but there is a condition attached to it. What is the condition? If it provides a material right to the customer. If it provides a material right to the customer. What is the meaning of material right? Tell me. I have discussed this in my class also, right? Tell me, what is the meaning of this one? What is the meaning of material right? Means if a customer is purchasing any goods, okay, then we are giving it to them. Okay, let's suppose I'm giving an example. Let's suppose a shopping mall says 10% flat discount to everyone. 10% flat discount to everyone. Is there a material right? No. But if the shopping mall says that if you purchase goods worth $1,000, I will give you a discount voucher of 20%. Then is there a material right? Yes, we do have material right. Right. So if there is a material right to the customer, then we will account for it this way. Otherwise, no. Now let us read the question. Of discount voucher. So it says Fuller wants to provide an incentive for the customers. Guys, first of all, please confirm. Is this paragraph clear to everyone? Is this accounting treatment clear to everyone? Discount voucher accounting treatment? No. Why? What's the query? Tell me. We have discussed in the class, no, that for a discount voucher, we recognize the discount voucher only when it provides a material right to the customer. If it doesn't provide any material right, we are not going to recognize that as well. Coming to that point. But is this treatment clear? That's what I'm asking. Is this treatment clear? Okay. Now, coming to the question. Fuller wants to provide an incentive to the customers. Coming to that point, Isida, So that's what is the question now. That's what is the question now. And you will get to read about it. Fuller wants to provide an incentive to the customers to use fullerfood.com rather than other, okay, competing online food ordering platforms. As such, Fuller is considering giving each of the registered customers a voucher for free delivery on the next order. So now what is it saying? That I will give to all the registered customers, I will give a voucher. Is there a material right in this question? Tell me. Is there a material right for this discount voucher? Is there a material right? No. No. So then what will we write here? What will we write here? So let's just copy this question. Copy. It is available for all, right? Hey, where is the discount voucher part? Yes, here it is. Right. As Fuller is considering, okay, so now you have to write does not, this does not create a material right. This does not create a material right for the customer. This does not create a material right for the customer and is awarded to customers for free. It is given to the customers for free. Take it, take it, take it. Now, explain the accounting implications, if any, when the vouchers are issued, and the vouchers are used. So now, when the vouchers are issued, tell me, have we collected any money from the customer? Did we collect any money from the customer? No. Then no treatment. No treatment. Now, further, when vouchers are getting redeemed, are we collecting any money? Are we collecting money? No. When vouchers are redeemed, no treatment. No treatment. Yeah, or you can say no treatment, or you can say rather you say reduce the okay, or I say recognize revenue only to the extent of amount received. I'll give you an example so that you can relate to this one. Let's suppose Shoppers Stop has given a 10% discount voucher to everyone. Now you go and purchase a merchandise, okay, or you can say a t-shirt. You go and purchase a t-shirt costing rupees 1000, okay? And how much will you pay? Tell me. How much will you pay? Tell me. How much will you pay? 900. Now, how much is the revenue that will be recognized by Shoppers Stop? 900. Right? 900. So when issued, no treatment. When they are redeemed, recognize revenue to the extent of the amount received. Amount received. Tell me, is it clear? Is it clear now? Is it clear? Now, also, if because it is for 5 marks, we have done 4 points. So if you have 1 marks lapse, so you can explain the meaning of material right. You can explain the meaning of material right. You can explain the meaning of material right. Okay. Now, done. So these two done. Now what's next? Third part, using exhibit 2. Can I move on to exhibit 2, guys? Can you please confirm if I can move on to exhibit 2? Can you please confirm? Yes, tell me, Sita. How is it different from the one you discussed in the class? Okay. What I discussed in the class was, I told that if a customer purchases from me, I will give him a 40% discount voucher, which they can redeem in the future purchases. Now tell me, am I giving this discount voucher to everyone? Am I giving the discount voucher to everyone? No, I am giving the discount voucher to a specific customer who just purchased from me. So if you have purchased goods, then I am giving you the voucher. Otherwise, no. Otherwise, no. Meaning thereby, okay. Uh, let me show my notebook to you guys. Just give me a minute, please. I want to explain this part to you guys. Is my notebook visible to all of you? Is my notebook visible to all of you? No? Okay, just give me a minute. Screen 2. Is it visible now? This is entity. This is customer. Okay. Now, entity is giving customers 10% discount voucher to all the customers, everyone. Now further, entity says that I am giving to my customer, okay, 40% discount voucher, plus I am giving to my customer a product A costing $1,000, and I am collecting from my customer $1,000. Now tell me, what is the transaction price? Tell me in this case. In this case, what is the transaction price? 1,000 is the transaction price. Tell me. In this case, 1,000 is the transaction price, right? Now, and what is the performance obligation for me? So definitely product A is the performance obligation. Now coming to this is a performance obligation not. So standard says that this will be a performance obligation if it gives a material right to the customer. Now comes the question, does it give material right? Does it give a material right? Now it says that generally to all the customers we provide 10% discount voucher, but to this customer I am providing 40% discount voucher, which will be redeemed in future purchases only, not in this purchase, redeemed in future purchases. Now when the customer comes in the future, he will get 40% discount. But now tell me, what is the additional benefit that this customer is getting? 30% extra? 30% extra? Tell me yes or no. Is this 30%, is this 30% received by any other customer who doesn't purchase the goods? Right? So meaning thereby, I am giving this 30% extra because he has purchased the goods from me. Because he has purchased the goods from me. So that's why it becomes a material right. That's why it becomes a material right. Now, since it becomes a material right, what happens? I have collected 1,000. So I am saying that for 1,000, I am giving to the customer two things: product A and discount voucher. So this is the transaction price. This is performance obligation 1. This is performance obligation number 2. Now I will allocate 1,000 to this and to this, to performance obligation 1, to performance obligation number 2, and recognize the revenue for performance obligation number 1, and recognize a liability for performance obligation number 2. In the future, when the customer comes and redeems the discount voucher, I will reverse my liability and recognize a revenue. But now in this case, did I collect any amount from the customer? In this case, did I collect any amount from the customer? No, I didn't collect any amount from the customer. So will I record any liability? No, I will not record any liability. So when the customer actually redeems this discount voucher of 10%, what will I do? Whatever amount the customer gives me, I will record as revenue. Is that clear, Isita? Is that clear now? In second, how much amount? So now you have to calculate the fair value of this discount voucher. So if you can recall, we discussed in my class that you have to assess what is the amount of discount voucher, what is the expected discount, that your probability of expected discount that you are supposed to give. Okay, so you might think that, okay, I have to give 30% discount, I have to give 30% discount. Now, what is the fair value of this? So the company has to estimate the fair value of this 30% discount voucher. Let's suppose this fair value comes to dollar 200. This fair value comes to dollar 200. Then what will you say? So the transaction price of discount voucher is 200. The transaction price of product A is 1000. Now allocate this 1000 to product A and discount voucher, and accordingly recognize revenue for this, recognize a liability for this. On redemption, reverse liability and recognize revenue for discount voucher as well. Okay. Still, if you have queries in this part, I will recommend you to watch the regular lecture for that. Provision create for the voucher? No, we don't create any provision for the voucher. It's a separate performance obligation. So we don't create any provision for the voucher. Okay. It's a separate performance obligation. So we have to recognize revenue when the voucher is redeemed. Now, coming to the next question. Using Exhibit 2 and in accordance with IS 30, you said to recognize liability. If we have collected money from the customer, but we have not provided him the goods or services, what is that called as, Isita? If we have collected money from the customer, but we have not provided the goods, not satisfied the performance obligation, deferred revenue. And what is deferred revenue called as? And what is deferred revenue called as? Liability. So that was a liability I was talking about. Clear now? Clear? Now. So for discount voucher, we have collected the money from the customer, but till the time customer has not redeemed the discount voucher, we will continue recording it as deferred revenue or a contract liability. When the customer comes and redeems the discount voucher, we will reverse the deferred revenue and recognize it as revenue. Now, coming to the second part. Using Exhibit 2 and in accordance with IS 38, intangible assets, explain how the technology and the data held by Fuller should be accounted for in its financial statements, and discuss whether the accounting treatment of Fuller technology and data provides its investors with full useful information. Okay. So what is the question talking about? Exhibit. So during the year in 31st December 2007, Fuller has invested in technology which collects data about food orders and deliveries from Fuller's computerized operating systems using algorithms, transforms it to artificial intelligence powered information. As additional data is collected and transformed, the AI continually improves its knowledge of factors such as traffic conditions at certain times of the day, and so the value of AI powered information grows exponentially. Oh my God. So it says that we have enabled AI into our systems, which will understand the demographics of the customer. Okay, from where the customers are ordering, what time they are ordering, what type of food they're ordering, what are their tastes and the preferences, everything they'll study. Okay, now Fuller uses the AI powered information to provide an increasingly efficient services connecting delivery drivers, restaurants, customers, so resulting in higher revenues and reduced costs. Fuller has put in place robust security measures to protect the raw data, algorithms, and AI powered information. Fuller paid a third party this much for data management software. So, what is the amount of payment that we have done? So, for data management software, we have paid $820K. Now, further, it says for a further 1.2 for AI technology, we have paid AI technology. We have paid how much? $1.2 million. Further, it says It employs skilled individuals to refine and streamline these algorithms on an ongoing basis. Okay, salary to refine and improve is how much? Dollar 630K. This is what they have paid. Now, can you tell me? So it says that how it should be accounted for. Now tell me, how will we account for this one? How will we account for this one? Tell me now. Come on, guys. How do you think will we account for this one? So directly we can say we will capitalize these costs. We will capitalize these costs. Now, but you have to justify why for this one, for this one, for this one. You have to give a justification for each one of them. Why? What would be the justification? So now, when you've incurred the expenditure, definitely you will have future economic benefits. What is the future economic benefits? So if you understand the demographics of a customer, if you understand their taste and the preferences, the timing of the order and the data and all the analytics, if you understand, definitely you will be able to sell in a better position, right? Reduced cost, increase revenues, definitely, right? So accordingly, you have to give the reason for this one. You have to give the reason for this one. Now, this part still can be debatable, but this and this is not debatable at all. This and this is directly, you can say, capitalize. Salary to refine and improve. See, understand, when we capitalize the asset, subsequently we don't capitalize any further costs. Okay. Now understand, once we develop the AI software and we have capitalized the amount, so it is asset is under use now. Now, when the asset is under used, still I am incurring salary costs to refine and further improve it. Question is, can we capitalize this part? Can we capitalize this part? The answer to that is yes. Why? Because see, the value to Fuller of these improvements, the algorithm significantly exceeds the benefit paid to staff to refine them, right? So there is a significant economic benefit. So yes, we can capitalize them. We can capitalize them, right? So benefits are increasing. It is not maintaining. Very good point, Isita. It is not maintaining the benefits. It is increasing the benefits. So yes, we can capitalize these costs. Okay, now you need to write the logic behind each and everything. This is what you have to do. Now, subsequently, what will you write? So first 3 points is this one done. Then subsequently, you have to write, you have to amortize it. You have to amortize it. Then amortize 1 point done. Okay, then you have to can say it will not be amortized. It will not be amortized if no amortization, if they have indefinite useful, no amortization, if they have indefinite useful life, if indefinite useful life, in that case we will do impairment testing annually. Okay, further now tell me, if entity wants to record this at a revaluation model, is it allowed? Revaluation model will be allowed? Tell me, do you think revaluation model will be allowed? Revaluation model will not be allowed. Why? Because no active market exists, because this is something specific to me. This is something very much specific to me. So there is no active market. So revaluation model is not allowed. Revaluation model is not allowed. Tell me, is that clear, everyone? Is that clear, everyone? Now, so this is the first part. Now, second part. So its first part says, using Exhibit 2 and in accordance with IS 38, intangible assets, explain how technology and data held by Fuller should be accounted. So this is the first part. This is the first part. Copy, paste. This is the first part. Now comes to part number 2. What is the part number 2? Discuss whether the accounting treatment provides any useful information. Now, this question is from conceptual framework. This question is from conceptual framework. You remember studying the term useful information in conceptual framework. Now, what is the meaning of useful information? So useful information basically means that it is you can say see, though useful information has fundamental characteristics and enhancing characteristics. Okay, so now fundamental characteristics means faithful representation, free from bias. Okay, and material relevance. Now, enhancing characteristics of it are comparability, timeliness, understandability, right? Consistency. All these things are there. But we are not going to write everything. We'll write only the what is required here. So we'll write faithful representation, faithful representation, faithful representation, and relevance. Useful information means faithful representation and relevance. Now, the data that the accounting treatment that we have given for these costs, does it faithfully represent everything? I don't think so. Why? There are a lot of challenges. First, tell me the costs incurred for development, does it represent actual value of AI of this software? Tell me, does it represent actual value of this software? This software has a very huge potential. AI has a very huge potential. Now, but no, the cost does not represent. And IAS 38 disallows IAS 38 disallows revaluation model. Revaluation model. So this cost model does not faithfully represent. Cost model does not faithfully represent. Represent. No, it does not. Further we can write active market we have written because there is no active market point. Then it says, see, if you read this question, if you read this exhibit particularly, you will get to know some things. Fuller has invested in technology which collects data about food order and this one. Now, so we have data about food orders and deliveries. Tell me, can we recognize this data? Customer data. Customer data. Can we recognize this? Can we recognize this? No. IAS 38 disallows again. Do you think it is correct? Do you think it is correct? No. It's ideally it should be recognized. Ideally, it should be recognized. But no. So again, when you say about accounting treatment, so definitely since there is a conflict between the conceptual framework says the data, the information that you represent in the financial statement should faithfully represent everything. Okay, now, but it doesn't faithfully represent. So it is in conflict with the standards. So definitely we'll follow the standards, but we are required to highlight here what exactly are the conflicting points. What exactly are the conflicting points? So we have to highlight those. What are exactly the conflicting points? So this is customer data. Now, what else? What else? What else? Now, AI, as additional data is collected and transformed, AI continually improves its knowledge of factors such as, so now you can also write this point. You can write this point also here to substantiate this, to substantiate this, to substantiate this, because cost model will not fairly represent the value of this software because AI continually improves its knowledge of factors and hence the fair value will keep on increasing. Rather, in the cost model, the asset gets decreased. Further, what? Efficient service, okay, collecting orders, done. This part, cost is recognized, employees skill levels, okay, the value to the fuller is improved. This much only, I think, as per me, I think this is the value that these are the 3 points which we can write here. These are the 3 points which we can write here. Okay, you can say that these conflicts, these restrictions uh, does not enable fuller FS to be to faithfully faithfully represent all the relevant and required information to investors who will lack sufficient knowledge about efficiency of these software and might undermine its value. Done. Assess if the life estimates of intangible change from indefinite life to definite life. But how it will happen? That assessment we anyways do. No, that the assessment, the standard also says us to do. Right? So we are saying where what is the conflict between the framework and the standard? What you are saying is that already the standard allows. Okay. So this is how we have to write our answer. I believe this discussion of the pre-mock paper has given you a fair understanding of how to write the questions. Okay. That's all for the day.